Hello and welcome to the CNBC-TV18's Mumbai newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh and you're watching Mutual Fund Corner. And today is going to be all about fixed income investing and mutual funds as well in a rising rate scenario. Devang Shah, the co-head fixed income at Axis Mutual Fund, and Raghav Iyengar, the chief business officer at Axis AMC, will be joining us now. But before we initiate this conversation with the gentlemen, Pavitra, tell me first, what is happening as far as the fixed income schemes are concerned? Why are they seeing outflows?
Well, let me actually take you through that. It's very interesting. Sonal, we have been talking about this data continuously, and a key trend that we have been pointing out over the past several months is that while we have seen a continuous inflow into equity schemes, the SIP contribution has also been moving up. In fact, for the last month, it even crossed that 13,000 crore mark. Debt schemes have been seeing outflows. So the chart will come up for you on your screen, so you can really look at the figures. The September figure, of course, looks very inflated because of standard quarter end activity. Don't be shocked by that. But even the rest of the months will show you that there has been a declining trend in this category. In fact, if you look at even the hybrid schemes, the outflows continue there as well. So the last month, that is for October, we got around 2,800 crores in terms of outflows. And this is actually the 5th consecutive month that this category has seen an outflow. Even if you take a look at what was the hugely popular category in 2021, that is the Balanced Advantage Fund category, that has also started seeing flows move out. So, for October, we had around 450 crores moving out of this category. So, but today, we're going to talk about what is the case for investing into fixed income at a time like this. You have interest rates moving up. You have all of this macro volatility, macro risks at play, which is causing an extremely volatile environment. So, at a time like this, why does it make sense to look at fixed income and who is it best suited for? So, let me go to Devang first. Devang, good afternoon. Thanks a lot for joining us. So, my first question to you is exactly that. Why do you, really see that, why are we seeing this kind of outflow in this category? And why do you think that this is a good time to be looking at the fixed income space?
Yeah, so thank you. I think I appreciate that, yes, a lot of outflows have happened in the last 6 to 9 months in fixed income. But at the same point of time, if you actually look across, we have so many other categories where actually AUM has grown. Net debt AUM broadly has increased by around 40 to 50,000 odd crores over the last 6 to 7 months. If you have actually looked across at markets, I think there has been a significant front loading of rate hikes, not only in Indian markets, but also globally. Central bankers have done a lot of front loading of rate hikes. I think Fed went from discount to 4%. If you look across at Indian Central Bank, I think the repo rate has been hiked from 4% to 590. Absolute operative rate has actually moved from 335 to close to 6% now. So it's been a 275 basis increase in operative rate, and which has actually led to significant volatility in yields and uptrend in yields in the last 6 months. Obviously, we had to see some bit of pressure on mutual fund schemes, and we have seen some bit of outflows. But I think a large part of the redemption or the pain in bond yields is behind us. In fact, incrementally, we have started seeing flows in categories like target maturity funds, short-term corporate bond funds, which are generally running 2 to 4 year mercury duration. We're actually seeing a lot of inflows back in the last 1 month or so.
Okay, so that is about the case for investing in fixed income mutual funds. Raghav, let me come to you. Now, in that case, how do you think should investors go about deploying funds in fixed income instruments, be it debt funds or bonds, in the context of rising interest rates that we've been talking about?
So I think, first of all, thank you for having us on the show again. I think we're talking about a very, very out of flavor category today. As Devang pointed out, there's been huge redemptions, and of course, inflows are also back. But this is a 2 lakh crore category in the Indian saving market. After real estate, fixed income instruments, typically bank FDs, bonds, other FDs are a huge part of an Indian investor portfolio. So I think it's a good topic to talk about. Mutual funds have all kinds of schemes, starting from overnight, where you can put money practically for a day, all the way up to really medium to long-term funds. So I think today, if you want to really capture an upside in interest rates, which I think is, as Devang said, is happening and has already happened a lot in the last couple of quarters, I think we could look at something like a liquid fund or an ultra short-term fund or a money market fund. So ideally, each investor obviously has to look at their risk appetite. There are various schemes looking at various types of investments. Some are AAA schemes, some are AA schemes. But ideally, yes, an ultra short or a money market fund is a great place to sort of capture the interest rate upward movement today.
All right, got that. Raghav, my next question to you is, what do you see as the key risks in this category? It's not like this is a completely risk-free category, of course. So what are the key risks that you see here? And then who do you think that this is best suited for?
Okay, I'll answer your second question first, Pavitra. I think this category is suited for just about every investor. I think whether you are a first-time saver or you're a pensioner, I think you need fixed income in your portfolio. Largely because fixed income behaves very, very different compared to equities, right? It adds a certain amount of stability to your portfolios. It acts as a place where you can take outflows from. Now, I think in terms of what are the risks, I think the biggest risk is the risk of possibly putting money into a scheme which is lesser, which is you need to have, let's say if you have money for a year and you're putting money into a scheme which has a, let's say, a 2-year duration, the risk of mismatch between your investment timeline and the scheme timeline is the biggest risk, because you will need to take out money after a year, whereas the fund manager typically has a 2 to 3 year kind of a view. So mismatch of time horizon, to my mind, is the biggest risk. And people tend to get carried away by past returns here, like in all other investment categories. And I think that, unfortunately, in a falling interest rate scenario, which we saw, for example, in 2018-19, I think you saw a lot of money coming into funds which actually were, to my mind, riskier than what the investor thought they were, just by looking at past returns. So I think the earlier rule yet applies, like in all investment categories. In fixed income, it's much, much more appropriate. In fact, if your last 1 year return is not very good, I think that's the time to actually think of deploying more money into fixed income at that time. Yes.
Okay, that is some interesting take on what would mismatches look like in case you are investing in these kind of funds. Devang, that takes me to the next question. Right now, we are in a scenario where interest rates are rising. But of course, we are talking about inflation coming down to some extent, not completely. In that scenario, do you expect this to continue? And what is the outlook for fixed income in, say, 2023?
I think, first of all, if we all need to understand that inflation has started coming off from significantly higher levels, and it is coming off from Indian context. Core inflation, headline inflation has remained above 6% for long. RBI's mandate is 4 to 6%. So even if we are talking at inflation coming off, it is coming off from the 7 series to 6 handle. Probably for the next 6 months, it will hover between 5.5 to 6%. But it's still significantly above the RBI's mandate of 4%. So yes, there are good news, but not to a level where we start expecting rates to significantly collapse or yields to collapse and we start seeing RBI shifting stance to rate cuts. What our view is that looking at the trajectory on macro, specifically if you look at growth, inflation, which are most important parameters which a central banker considers, and the external sector, I think somewhere down the line, the growth is quite sanguine. If you look across at the macro data, high frequency indicators, there are no sign of slowdown at any point of time right now. If you look at the inflation trajectory, it is trending downwards. So what would probably RBI do? And looking at the external world, where Fed is still talking about hikes, we are not done with all external economies' rate hikes. I somewhere down the line believe that RBI will continue with its pace of rate hikes. They will continue with moving towards a terminal rate closer to 6.5. But incrementally, rather than doing 50 basis every policy, they can move to a 35 in December, and then probably February rate, they might do a 25 basis hike. So I think probably the quantum of rate hikes will now start to fall. We are nowhere probably talking that this is where I think the rate cuts begin. I think rate cuts probably will be, even if it happens end of 2023 or probably 2024. It is still far away for the rate cut cycle to begin. In this environment where we are actually expecting a slow pace of rate hikes, large part of these rate hikes already being priced in across various points on curve on fixed income, what we advise clients is probably to stick to the short end of the curve. And as Raghav highlighted, I think match the investment horizon. If the investment horizon is less than 1 year, I think ultra short-term money market funds are the best funds to invest with. One important thing which investors needs to know is that the operative rate, or even if today if you are investing in a 3-month CP, I think the 3-month CP rates have crossed 7%, which as early as April this year were at 3.5. So the actual incremental deployment in fixed income will fetch you as minimum as 7% on returns. So that is the point we are trying to put across. I think large part of the rate hikes is done. incremental rate hikes to the tune of 6.5 are already priced in. We don't expect too many surprises, and hence matching the investment horizon. If it's short-term in nature, use parking strategies like money market funds or low duration funds. And if it is medium-term in nature, probably use short-term funds or target maturity funds for investments. So that's our outlook on fixed income.
All right, got it. And Sonal, this is, not a space, not a topic that we talk about too much, right? Not everybody has that huge time horizon. They might want to pull out money in 3 years, 5 years. And for those kinds of investors, this could be a great category. But Devang, Raghav, we have to get into a short break now. I request you to please stay on because we have lots more questions coming up for you in just a bit. Welcome back. You're still tuned in Mutual Fund Corner on CNBC-TV18, and we still have Devang Shah as well as Raghav Iyengar with us. The next question I want to talk about is something that we get asked a lot, which is that what should your portfolio composition really look like? Now, of course, this is different for every single investor, but say that you do have a big expense coming up in 2 or 3 years' time, how would your composition really look like?
If that's for me, Pavitra, I'll take it because I can answer that with a true life example.
Go ahead, right? Please go ahead, yes.
My child is going to finish her 12th standard and she gets into university next year. So I know that I have a fairly large amount of money that we have to spend on that. So I would put actually about 90% of that total amount that I estimate to spend into fixed income securities, right? And that will be a mix of ultra, maybe short-term bond fund, because I know that I will spend that money over the next 1 to 3 to 4 years out. So, but that's me, right? There are many people who have a 60-40 theory, 60% equity, 40% debt. That's at a very macro level. But I think it's very individualistic. So when you get or you know that you have a certain amount of expenditure coming up and you're reasonably clear that that has to be spent, that kind of money immediately must go to fixed income. And the beauty of putting that into mutual funds is that, you unlike other fixed income instruments, you don't pay tax till you actually take out the money. So let's say you are budgeting for an expense in 3 years, and for whatever reason that 3 becomes 4, you don't have to worry about paying tax in the 3rd year. You actually pay tax when you actually take it out, and you pay tax only on the amount that you actually take out. So if you say kept 100 and aside, and instead of spending 100 you spend only 80, you will actually pay tax only on the amount that you remove it out. So I think those are the benefits. And obviously, as I had mentioned in the beginning of the show, fixed income is largely more stable, more steady, right? So when you know that you have a certain amount of money coming up due, it's better to keep it in such instruments.
Okay, so Devang, the next big fear, of course, is how long will this rate cycle continue on the upward side? So what do you think? How different is the current interest rate environment from the Walker era? I hope we don't go to that era, 20% interest rates, but at what level do you see the US Fed peaking? What is the outlook here?
So our understanding is that data specifically on the US front has started showing some bit of softness. So I think probably March 2023 is where we believe global markets or Fed will probably pause. And after that, we should not see significant rate hikes from US Fed. When it comes to Indian central banker, I think probably the next 2 policies is where we will see most of the rate hikes. So the markets are divided between 35 and 50 for next, and probably a 25 in February. I think somewhere down the line, 35 in December and 25 in Feb, and take the operative rate to 6.5 is where we believe RBI would also go. Most part of 2023, I think Indian central banker will be on the pause because we have not hiked rates so much as developed markets, because I think we start from 4 or probably 335, and we are moving only to 6.5 as compared to where Fed has moved from almost, as I told you, from 0 to 5. I think once this global central bankers start cutting rates, we would not follow them as quickly as market is expecting. So I think Indian central banker, we would be more on a pause for most part of 2023. Fed, there is a possibility, yes, that market starts sniffing a rate cut in the last quarter in 2023, and hence we can see some bit of rate cuts in US Fed.
All right, got that. That is on the outlook for, where the interest rate cycle could be headed. Raghav, the next question is actually about where you should put your money, because it's not as easy as saying that I'm going to put my money in fixed income, right? There are so many categories inside and within this space that you can pick from. How do you pick? How does an investor choose within this space what really is best for them?
So ideally, anything from 0 to 30 days, overnight funds, 30 days to possibly and above liquid, anything less than a year, ultra short, money market, you take your pick. Make sure that you're just looking at the duration of these funds because as I mentioned earlier, your investment horizon should be at least higher than the duration of these products. Now, beyond a year to 3 years, it gets interesting. My favorite category is a bit of a fill it, shut it, forget it category called short-term funds. Right, and that's, I think, because it allows the fund. It's an interesting category. The fund manager has to have minimum duration of 1 year and max of 3 years. So he has enough, or he or she has enough play to, to manage the volatility in the market with that kind of a duration. These funds have very, very long track records. I think they are largely AAA oriented funds. So portfolio quality is not a problem. And I think most importantly, I think these funds have seen huge interest rate cycles in the last 10 years. And I'm sure, Pavitra, you agree with me, the last 10 years has been like an extremely active period across, especially on the fixed income market side. So even with that, they have done, many funds like Axis and all have done very, very well in the entire investment journey, right? So I think the category has done very well. And obviously, I think it allows the fund manager to do. I think, of course, the other big category which has sort of come up to play is what we call target maturity funds. These are essentially index funds in debt. Obviously, the big difference between them, or the similarity between them, and if you remember, there used to be a big category called fixed maturity plans, where there was investments put into a defined portfolio. Here it's the same. I mean, the fund manager puts money into a portfolio of that particular index. It has a certain maturity date. And so you are pretty clear as to when you're getting your money back. You're also pretty clear as to what those investments are getting into. Of course, being passive, there is no timing issue here. It's completely like the fund manager does not have a say in whether he wants to invest today or tomorrow or day after. Unlike in an active fund, whenever he receives money or receives a redemption, he has to take action immediately, right? And so the liquidity is obviously the big advantage. It's also a big disadvantage for people who want to, just put the money and lock it up. But again, a big category of money coming in, huge category of investments coming in. I mean, in fact, most of the money that's come in financial year 20, or rather calendar year 22 in the fixed income space has largely come into this category right now.
That's very interesting and great way to put it. But let me come across to you, Devang, because yes, while debt funds are important, considering the interest rate scenario that we are in, how do you see the flows panning, say, in calendar year 23? What is the outlook here? Because as Pavitra just mentioned a while back, there was an outflow this time around.
Yeah, so I believe so that somewhere down the line, I think the last 2-year returns in fixed income category has remained subdued. If you actually see, we saw a significant increase in rates at the beginning of the COVID episode, like Feb 2020. And Feb and March 2020 rates, 3-year corporate bonds, GSEC, everything spiked by 50 to 200 basis. After that, we have seen massive intervention from central banker. RBI did liquidity infusion, CR cut, rate cuts, widened the corridor, and most of the gains happened in the first quarter. So April 2020 to June 2020, most of the gains on fixed income happened because yield collapsed by 100 to 150 basis across the curve. After that, investments have delivered subdued returns for the last 2 years. If you actually see last 2-month returns on fixed income has been quite good. Incrementally, we believe that most of the pain is behind us. Once the 3-6 month return starts looking good, I think somewhere down the line, investors will also get a lot of confidence and probably we start seeing flows. As per me, I think the short to medium term category will be the biggest beneficiary for 2023 calendar year, and that is where we believe maximum flows will come. Investors start liking this target maturity funds and passive investing. So you can see some bit of inflows in target maturity funds also, but I think the short to medium term space is where we believe flows will come in 2023.
Okay, short to medium term fund, that was definitely a masterclass in fixed income. We learned a lot, and hopefully our viewers as well. Devang Shah and Raghav Iyengar, thank you so much for joining us today and taking us through what this particular segment in the mutual fund industry looks like, and hope to speak to you very soon again. And with that, it's a wrap on this edition of Mutual Fund Corner. But do remember to email us your queries and we will address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.